Stop everything you're doing right now. If you look away for even a second, you might miss the exact moment the entire financial landscape turns upside down. Silver didn't simply rise, it surged forward aggressively. And if you still view this as nothing more than a routine rally, you're approaching the situation far too simply, while others are positioning themselves strategically for the long game. Before we dive deeper, a quick note. We have a growing community of more than 1,000 members who receive exclusive daily videos and priority access to every new release on this channel, ensuring they remain completely informed about market developments. If you'd like to stay equally up to date, think about becoming a member. It only takes a moment. Today, we're launching a straightforward giveaway, 20 ounces of pure silver. To participate, simply like this video, subscribe to the channel, and leave a comment sharing either your preferred form of silver or your price forecast for silver this year. That's all. At the end of the month, we'll select a winner during a live broadcast and reveal the name on camera. Simple and transparent. But the giveaway isn't the main focus here. The real message is this. When silver reaches triple-digit levels while everyday life still appears completely ordinary, that isn't just an interesting headline, it's a serious alert. The strangest aspect is that your weekly grocery bill remains unchanged at the register. The stock market continues acting as though it's unbreakable. Most individuals go about their routines as if absolutely nothing has shifted, yet something has clearly shifted. Recent market reports show silver trading near $115 per ounce after briefly climbing even higher during the trading session. Gold, meanwhile, stands well above $5,200. Those aren't rounded numbers for effect, they're precise figures sending a clear message. So the issue isn't whether silver increased. The real question is, why did silver advance so sharply before any major crisis became front-page news? Keep that question in mind because shortly I'll share the single signal that nearly everyone is overlooking, the one factor that separates a short-lived surge from the beginning of an entirely new economic era. Before we reach that point, note that additional resources appear in the description, including options for premium access and deeper content. Those who choose premium levels receive specially produced videos with greater research depth, clearer organization, and more thorough analysis, exclusively for them. Keep that in mind, because the coming months will favor those who prepare ahead rather than those who merely respond after the fact. Now let's examine what has actually occurred, without exaggeration, without fear-mongering, and without the empty to-the-moon rhetoric. I recently spoke with a close contact who operates deep inside the mechanics of global money flows, not just surface-level price charts. I asked him directly, am I imagining this? We're seeing massive gains, yet I still feel unsettled. He gave a short laugh, not of joy, but one of recognition. He compared it to watching a powerful storm approach while everyone else casually arranges outdoor furniture for a picnic. When silver shoots upward so violently, it isn't primarily silver triumphing, it's the dollar weakening dramatically. That's a critical distinction many still fail to grasp fully. If silver climbs to $150 but your rent doubles, your insurance premiums triple, and your salary buys far less, have you truly gained or have you merely managed to tread water? That's exactly why I repeatedly emphasize, stop fixating on the dollar amount your holdings display. Instead, concentrate on what those dollars themselves are turning into. Right now, the dollar is shrinking at an accelerating pace. From the most recent official filings and policy timetables, central banks remain positioned in a moderate interest rate environment, high enough to create pressure, yet not high enough to fully reset excesses. It's comparable to applying steady force and then acting surprised when fractures appear. We discussed what would truly signal the decisive phase. His response was direct. You'll recognize the decisive phase when the next large-scale rescue operation begins. Not subtle, behind-the-scenes liquidity adjustments or minor technical fixes, but a clear, aggressive move back towards zero rates combined with trillions in new injections because critical parts of the banking system begin seizing up again. That's when the composed exterior cracks openly. And here's the key tension. Silver's recent explosive move typically appears after such a rescue effort. So why is it occurring before? That's the question that should keep thoughtful people alert.
If silver is moving in anticipation of a bailout, it suggests that those positioned closest to the financial infrastructure are detecting signals the broader public has not yet seen. That doesn't automatically mean global collapse arrives tomorrow. It does mean the overall risk level has risen noticeably. I want to address a claim frequently repeated within precious metals communities, even by analysts I admire, that paper-based silver holdings will become irrelevant, that only physical metal will count, and that derivatives will collapse to zero. My perspective is more nuanced. In a genuine systemic breakdown, counterparty risk does indeed become enormous. A contractual promise depends entirely on the system behind it. Yet history also shows that markets can remain operational far longer than many anticipate, and paper instruments can serve a useful bridge during transitional periods. I'm not advocating any single approach for everyone. The essential point is to understand precisely what you hold, the purpose it serves, and the specific conditions required for it to deliver. Physical metal provides independence and a tangible hedge you control directly. Paper positions offer liquidity and maneuverability until they no longer do. The real hazard isn't owning an exchange-traded fund or similar vehicle. The hazard lies in believing that vehicle is equivalent to metal you physically possess. Those are fundamentally different categories, and the faster prices move, the more critical that distinction becomes. My contact said something that struck me forcefully. This moment is dividing those who are still investing from those who are already exiting. That's perhaps the clearest summary I've heard. Some purchase metals hoping to increase their account value in dollar terms. Others acquire metals because they no longer trust the unit of measurement itself. When that measuring unit begins distorting, the second group stops focusing on daily fluctuations. They begin counting ounces the way someone counts life preservers. Even so, practical reality remains: volatility. Silver rarely climbs steadily like steps on a staircase. It tends to move like an elevator with a snapped cable: sharp rises, sharp drops, then another surge. We discussed potential corrections, and I'll be candid, a significant pullback would not surprise me whatsoever. In fact, it would align with normal market behavior. The critical factor isn't whether a correction occurs, it's what follows the correction. Some pullbacks represent nothing more than a brief pause for breath. Others represent the final opportunity before a major shift. You only identify which type it was after the fact. If you've already built a strong position, feel free to share your journey in the comments. It can encourage others. Now let's address something that confused many viewers recently. Why does silver prices appear different depending on the source you check? People have been reaching out saying the quoted spot price shows one number, while the actual cost to purchase physical metal shows a noticeably higher figure. I put the question directly to my contact. Is this evidence of a genuine shortage? Is the market breaking apart? What's really happening? He didn't claim insider knowledge of every dealer desk. Instead, he explained it from a broader monetary perspective. He described silver as operating in several distinct but overlapping markets that only appear unified during calm periods. When tension rises, those markets begin separating. One lane is the retail investment world, individuals purchasing coins, rounds, or bars because they want tangible ownership they can store, trade, or keep nearby. Another lane is the industrial consumption world, companies requiring specific grades and forms of silver for manufacturing processes, not simply a collection of retail products. A third lane involves futures contracts, warehouse inventories, delivery protocols, and the entire legal financial framework that produces the widely reported spot price. In stable conditions, these channels run roughly parallel. During stress, they diverge. An industrial buyer cannot simply deliver a box of assorted retail coins and expect them to feed a production line. They require precisely refined material, standardized bars of consistent purity, and reliable delivery schedules. So even if retail premiums appear moderate, industrial premiums can escalate sharply. When key manufacturing centers compete fiercely for limited supply, they pay whatever premium is necessary because the cost of production halts exceeds the extra expense. That's how you end up in an environment where one price flashes on trading screens while another price reflects what a desperate buyer actually pays in the real economy. and when those prices begin drifting apart noticeably, it signals strain within the system's infrastructure. If that divergence widens further, the implication extends well beyond silver. It becomes a real-time demonstration that quoted prices do not always equal economic reality. Once large numbers of people absorb that lesson, perceptions of money change rapidly. That's why I monitor not only the headline number, but also the behavior around it. Let's step back and confront the difficult question. Is this advance occurring because we've already entered the decisive phase, or is it merely a preview of what's coming? My contact leaned towards the preview interpretation. He pointed out that widespread panic buying has not yet materialized. We're not seeing obvious signs of currency failure in daily life: empty store shelves, constant repricing at checkout counters, mass rushes to purchase durable goods. If those visible symptoms remain absent, why is silver behaving as if they are already here? That's when
He added another point worth remembering. Once you establish that core holding, step away from constant monitoring, stop obsessively checking prices, stop refreshing feeds every few minutes. Focus instead on building your life, developing skills, expanding income sources, strengthening your overall position. Return to metals only when you have fresh capital to deploy, because fixation can transform sensible preparation into emotional distress, and distress leads to poor decisions. I'll build on that advice with my own perspective. If you're just starting, don't allow a triple-digit price tag to convince you silver has become expensive. Price and value are not identical. A high-quoted price can reflect currency deterioration rather than metal overvaluation. So shift the question from "is it too late" to "what specific risk am I addressing?" If your concern centers on currency debasement and loss of purchasing power, then the relevant issue isn't the current quote, it's whether the underlying policies driving debasement have reversed. Based on the latest published data and official statements, confidence in the dollar's trajectory is not strengthening. I realize some listeners may think this analysis sounds overly alarmist, but let's remain grounded. Gold exceeding $5,200 is not routine. Silver near $115 is not routine. The truly remarkable element is how little urgency most people display in response. That disconnect between market action and public sentiment creates enormous potential energy. When sentiment eventually aligns with price behavior, movements tend to accelerate dramatically. Let's review the gold-to-silver ratio for additional context. It has been narrowing, meaning silver has outperformed gold recently. In straightforward terms, silver is gaining strength relative to gold. This can result from monetary buying, industrial requirements, speculative momentum, or a combination. When multiple forces converge, you observe the kind of repricing we're witnessing now. But here's an important counterbalance to prevent overconfidence. A contracting ratio does not guarantee a linear path forward. It can extend too far, reverse sharply, or mislead. If your entire strategy rests on the ratio reaching some predetermined target, you're building on unstable ground. Treat ratios as diagnostic tools, thermometers, rather than infallible predictions. My contact shared a personal anecdote that provides emotional grounding. He recalled his first substantial silver purchase when prices traded in the low 20s. He bought, then watched the market stagnate for years. That's the reality few discuss during periods of excitement. Patience. Preparation feels tedious until the moment it suddenly appears brilliant. The market tends to reward those capable of remaining steady, not indefinitely, simply longer than average attention spans allow. Right now, average attention spans are extremely short. If you arrived here because silver caught your attention recently, that's perfectly reasonable, but don't exit when attention fades. The period when general interest wanes is frequently when serious positioning occurs. Let's shift to a practical angle often overlooked. What does this development mean for your everyday life? If your sole interest is seeing larger numbers on a screen, you're missing the deeper implication. When metals advance sharply, they frequently reflect eroding trust. Trust in stable purchasing power, trust in responsible fiscal management, trust that savings will retain value. When that trust fractures, behavior changes.
People reduce lending. People avoid holding large cash balances. People migrate toward assets that cannot be created endlessly. That behavioral shift often fuels the next larger phase of the move. So ask yourself, are we still in the early stage where informed participants move discreetly, or are we approaching the stage where broader crowds rush in? Share your view in the comments. Are we early or late? Here's another question that reveals mindset. If silver dropped 20% or 30% suddenly, would you view it as a catastrophe or as an opportunity? Be candid in the comments. To calm the pace for a moment, let's revisit fundamentals without turning this into a dry lecture. Silver is unusual because it serves dual roles, a monetary asset and an industrial raw material. That means two separate demand drivers influence it. The monetary driver responds to fear, policy shifts, trust erosion, and human psychology. The industrial driver responds to manufacturing activity, supply chain requirements, and tangible economic needs. When both drivers accelerate simultaneously, price doesn't advance gradually, it surges abruptly. And right now, both appear active. On the monetary side, gold setting new highs, dollar weakness, rising uncertainty. On the industrial side, persistent requirements in electronics, renewable energy infrastructure, and precision manufacturing that cannot easily replace silver. I'm not suggesting silver is the only solution. Real estate, operating businesses, personal skills, and reliable cash flow remain essential. But silver functions as one of the clearest indicators of currency health, and the indicator is currently flashing warning signs. For anyone experiencing fear of missing out right now, that emotion drives people to buy near short-term peaks, not because they're foolish, but because they're human. Charts move, urgency builds, hands tremble, buttons get pressed. If that's your current state, pause, return to first principles, decide what portion of your net worth belongs in hard assets, decide what portion should remain liquid, define your time horizon, establish clear conditions for exiting. If those answers remain unclear, you're not preparing, you're speculating, and speculation faces harsh consequences in environments like this. Let's address the term endgame because it gets used loosely. Endgame isn't a calendar date, it's a sequence of events. One policy intervention triggers another, one rescue leads to a larger rescue, one erosion of confidence prompts further erosion. Eventually, the system requires ever-increasing doses of intervention to function. That's the pattern unstable monetary regimes follow. When my contact said we're not yet at the decisive point, but clearly heading in that direction, his caution and conviction both made sense. History shows currencies rarely collapse in a single dramatic event. They erode in stages: crisis, temporary fix, brief calm, renewed crisis, larger fix. Each intervention weakens the foundation further until the fix fails. You might wonder about the specific catalyst this time. People crave one clear trigger. Reality usually involves multiple pressures accumulating: rising debt service burdens, political gridlock, trade distortions, banking sector vulnerabilities, weakening consumer sentiment, shifting employment data. Eventually, something previously considered manageable becomes critical. Recent figures and statements suggest growing unease around the dollar, visible in the aggressive bidding for traditional safe haven assets. But here's a necessary skeptical counterview. Not every metals rally signals imminent systemic failure. Sometimes rallies occur because speculative positioning remains light. Sometimes they result from cascading leveraged flows. Sometimes they reflect anticipation of a policy shift that later proves less dramatic than feared. Respect the warning, but don't allow it to override rational planning. Recall earlier when I mentioned the overlooked clue. Here it is. The clue isn't solely the price level, it's the timing. Silver and gold are behaving as though a significant policy turning point approaches. Markets frequently anticipate rather than react. We're currently positioned near a major central bank decision period. Even if the public statement remains unchanged, markets sense potential shifts, perhaps toward rate reductions, perhaps toward renewed liquidity provision, perhaps toward hidden stress. Whatever the cause, markets aren't waiting for official confirmation, they act ahead. Waiting for the announcement means arriving after the move has already occurred. That's why actions deserve more attention than words. To those planning to wait for the dip, I understand the logic, it feels disciplined, but the risk is that the anticipated dip never arrives in the form or timing you expect, leaving you sidelined indefinitely. Inaction is itself a choice. Rather than all in immediately or waiting forever, consider gradual entry, scale in, purchase a portion now, add on weakness, add further when resources allow. That method reduces the emotional weight of needing to identify the absolute low. Scaling doesn't eliminate volatility exposure, it helps prevent complete paralysis. Important distinction. Regarding the "it's too expensive now" objection, prices can appear elevated in two ways. An asset can become overpriced relative to fundamentals, or the currency can become devalued relative to fundamentals. Most people recognize only the first dynamic. The second dynamic dominates in periods of sustained policy experimentation. That's why metals can reach seemingly absurd levels while remaining entirely logical. When the measuring unit shrinks, quoted figures expand. I promised several key takeaways, so here's another. If silver can reach $115 while public concern remains muted, imagine buyer behavior if a major banking headline breaks early one morning. Do you expect measured, patient accumulation, or do you expect immediate, urgent purchasing, like hitting an emergency button? Those moments reveal more about psychology than price alone. In rapidly moving markets, newcomers often gravitate toward complex strategies, leverage, derivatives, structured products. I won't judge, but I will caution. Complexity amplifies everything: gains, losses, and emotional strain. If you lack experience handling that strain, current conditions will teach harsh lessons quickly. New participants keep positions simple. Experienced participants maintain strict discipline. Emotionally charged participants step away temporarily. The quickest route to losses during a metal surge is treating it like entertainment rather than